Uh, Good afternoon. Uh, Last week, we went through some of the basic principles of the present value calculations as well as some corporate finance. We started our discussion with the present value of future cash flows. We went through some extensive theories as to how to calculate the present value as well as the future values of a given set of cash flows. Then we came up to certain couple of patterns like annuities and perpetuities. We discussed how to calculate their future values and present values and representatively. Finally, we came to the core concept of the last week's session, that is on the net present value. Uh, we wind up the session last week with a note on both the net present value and IRR, internal rate of return, could be two distinctive methodologies which we can use to evaluate certain cash flow. So it could be anything. It could be a project cash flow. It could be an investment of a fixed income security, which we are discussing today. So any periodic or let's say a distinct number of patterns of cash flows could be either we could use the equations what we learned and could be discounted, or could be compounded and calculate the present value and future value accordingly. So today's session, we are continuing from the last week's point. We will touch upon few exam questions in the recent couple of years, 2019, 2018 and 17. That's for half of the section, and the rest of the half, we will continue our discussion on to one of the most interesting areas, that is on the pricing of the fixed income securities. We are categorically discussing treasury bond, treasury bill pricing, and some of their theoretical background. So hopefully, next week would be the last week of our theoretical discussion prior to coming for a revision class, as well as we can attempt a few more mock questions in between this time and your examination time. So next week we will be winding up our discussion with the portfolio theory. It's not a major theoretical area, rather an extension of net present value and treasury bond pricing that we are discussing today. So hopefully with that knowledge, you will be fully fledged to face the examination, and that is on one aspect. And on the other aspect, you may have gained some ample knowledge on statistics and business mathematics and their applications, which will be really helpful for your day-to-day mathematical calculations as well as for your next level financial management subject. This would be a stepping stone. So having said that, let's start today's discussion. We'll first look into some of the questions that is coming from this area on time value of money and basics of corporate finance. Then we will be hopefully coming to the second part, that is on the valuation of fixed income securities. We will try to complete this session. Provided we can't do it on time, we will carry out to the next session as well. Okay, right. So these are the areas that we just discussed on the last week discussion, and we will freshly start upon with the questions. So first question I'm quoting for this discussion is 2019 September. This question we have two areas being tested, part A, part 1 and part 2 being tested from the net present value. Part 3 and 4 we will postpone to the next week. We will start with the once we come up with the theories on the treasury bond and treasury bill calculation, you will be in a better understanding. Even you can attempt this now with an assumption of this is just cash flows, but for the betterment, we will just postpone part 3 and 4 for the last week's session. Okay. So first, we will go through the question and see what it says. I'm quoting 2019 elective question number 4. A foreign investor is considering two investment proposals. Proposal A involves an initial payment now, so that's the investment of USD 400,000, and then it will return 100,000, 300,000, and 200,000 respectively in year 1, 2, 3's time. So that seems to be the horizon of the project. We'll start with 0, 1, 2, and 3. Seems to be the end of that project A. Okay. Look at proposal B. It suggests investing in a corporate bond with a face value of 400,000. Now, if you look at that payment of 400,000 and this face value of 400,000, now this seems to be same initial amount of investments. That's the core that we can take from this line. Face value of 400,000 and an annual coupon rate of 8% paying annually. Okay. With a remaining maturity of 3 years. The current yield to maturity of this 3-year bond is 10% per annum. Now that part, the latter part, will be helpful for part 3 and part 4. For the moment, let's just focus on part 1 and 2. Calculate the net present value of proposal A. Part B is asking to assess whether investment proposal A is viable. Okay, we will just try that part. Okay. So importantly, I reiterate, now whenever we have a question of this nature, let's say anything to do with a timing on one axis, the easiest and the most crucial thing to do is to draw this line. What is this? This is nothing but a small line of time, 2 and 3. So this is the horizon of project A. If you look at the initial investment, we are looking at 400,000 in the currency. I will name this side as the cash flows. CF stands for cash flows. Then what do we can get from this project? We can get 100,000, 300,000 and 200,000 at these respective years, year 1, year 2 and year 3. Okay. Now for us to compare and contrast these cash flows with the initial investment, what we have to do is we have to bring down these everything into today's term. What does the question ask? Calculate the net present value of the proposal A. So we are here on time t0 and these cash flows are on a future day. So what we have to do is to bring them down using either we can use the simple method of, okay, for this cash flow, this will be brought down by 100,000 divided by, interestingly, now in this question, there are two interest rates or discount rates being mentioned. Look at the question again, 10% is mentioned for discount factor for the project A. Now that 8% is for the next part on the corporate debenture evaluation. We will leave that 8% aside and we will have to stick with the 10%. Okay. So first method that you can do is you can write the theoretical formula like this. 100,000 divided by 1 plus the interest rate to the power 1 by, we have 1 year here. This cash flow, you can discount this by 300,000 divided by 1 plus, okay, I will write it directly. 1 plus 10% should be 1.1% to the power 2. So this is one aspect. The second aspect would be, and the easier one would be, to use the discount rates that is given in this question. What are these discount rates? This is nothing but the value of 1 divided by 1 plus 1. This is approximately close to 0.9091. This one, 1 divided by 1 plus 10% to the power 2 will be denoted by 0.8264. Okay. Now, get this concept very clear to the mind. Either you can take a cash flow, divide by this factor, or it is equal to this cash flow multiplied by this factor. Isn't that so? So that's why instead of this 1 divided by 1 plus 10%, we can use 0.9091. In that case, we have to do a multiplication to get the same value. Try both methods at your leisure time. You will find this and multiplying by this will give you the same answer. Okay. So So we don't have to really go through this theoretical way of hazards. Rather, we will use the project appraisal professional method. We have these cash flows here, and then we have the discount factors here at 10%. Okay. At 10%, the question has given us the discount rates. Nice. 1 here for the year 0, 0.9091 here, 0.8264 here, and 0.7513 here. When you have this easily, you can get the discounted cash flow by simply multiplying this. This is a negative number, you will get a negative 400,000. And then when you multiply each of these cash flows, you will be getting 90,910 here, 247,920 here, 150,620 here. What is the net present value now? We have this initial cash flow plus some positive cash flows, which will be running at different time horizon. So what we have to do is to take the summation of discounted cash flows, or we can call it as the net present value. This is nothing but the addition of all these together. And if this positive cash flows is going to cover up this negative 400,000 and still make a residual, that is what we are looking for. The net present value to be a positive number. To add these things up, 90,000, 247,000 and 50,000 minus 400,000, you will end up with a positive number of 89,450. Now this is the answer for part D. Calculate the net present value for proposal A. We have a nice proposal, initial cash outlay, and couple of cash inlays on different timing of year 1, year 2, and year 3. The question has easily given us the discount factors. But still, if you are not given, still you can use the old equation 1 divided by 1 plus 1 to the power 1, power 2, power 3 at this respective rates and get these numbers. Be careful of these numbers are approximations. You're not getting the exact perfect number. There will be many decimal points here, and when you multiply a larger number, you may get a marginally different number. Don't worry about that. Even if you use your own calculator or even if you use these values, both values will come to approximation of 89,000 and somewhere. Okay. So the answer for the part A is the NPV, or the net present value, is 89,450, and part B is asking assess whether investment proposal A is viable. If you could recall the previous discussion, we have said under NPV, if we have a net present value of positive number, we can accept that project. That project is making the wealth of this particular entity or the company or you more. If you have a negative number here, that means by running this project, you are depleting your initial capital or you are diminishing your value. So in that case, we can't accept such kind of projects. So answer for the part B or part 2 would be assess whether investment proposal A is viable. Yes, it is viable since the project is generating a positive net present value. So make sure when you've been asked to write a justification to your answer, make a small note because we are looking at approximately 5 marks. Just don't write only it's viable because it's a net present value of a positive number. Just write a bit of a theoretical background on what we discussed. Okay. All right. So part 3 and 4 we will touch upon once we finish today's discussion with the start of the next week's question. Okay. We'll focus on question number 5 of the same question paper. (2019) September. Okay. What does this question say? A hospital plans to upgrade its medical laboratory to provide a better service to patients. It seems to be an upgrading project. A medical equipment supplier has provided the hospital with an estimate of 50 million rupees for the required upgrade. 50 million rupees. This estimate is forecasted to rise by 10% per annum on a compound basis. That means, as of today, if you do this project, we need 50,000. But what if we do this project on 1 year's time? This is 50,000 plus 1.1%. So that means 55 million. Or if it is after another year, it will be 55 into 10% addition. Okay. Question is hinting you may use discount factors given in question 4 above. That's a question that we discuss as appropriate. We need to answer the following questions. We'll see what the questions are. First question. Calculate the estimated cost of this required laboratory upgrade in 3 years' time. Question B is asking, okay, we'll go by question because we have a lot of text to cover here. Right. First question is a straightforward question. As of today, if the project is costing you 50 million rupees, so that means this value is going to be compounded at a rate of 10% for a period of 3 years. If it is 50 million here, I am going to compound it at a rate of 10% for a period of 3 years, and I will get a value if you multiply this 50 million by this number as at value year 3. So 50 million multiplied by 1.1 to the power 3 will give me a value of 66.55 million in year 3. If I do the same project, assuming that our supplier assigned from us 10% will remain for the next 3 years. If I do this project after 3 years, this will cost me a value of 66.55 million. That's the answer. What we have done here, we have compounded. So this is the future value of 50 million after 3 years. Future value equals to present value 1 plus r to the power n. R is 10%, n is 3. Okay. Straightforward calculation. Look at part B. If the hospital decided to upgrade its laboratory immediately, now, not like this, now, okay, now, by obtaining a 3-year loan for 50 million, sensible. If you do this project after 3 years, this is the value that we have to consider. We do this value now, this is the value we have to consider, 50 million. So they want to do this project now. How do they going to finance this? By taking a loan at a rate of 10% per annum and repay in 3 equal year-end annual installments. That means there will be payment. I will denote payment by P. There will be 3 equal T's which will be compensating this 50 million plus 10% interest. Calculate the amount of annual installment. We have to calculate this P. We don't know that value. Now the question is giving further hints. Hint. Loan amount equals to the present value of the annual equal installments. Use the interest rates of the loan as the discount rate. What does this say? This loan, 50 million at a rate of 10%, is going to give me a set of cash flows. Right? Now the condition for us to obtain this loan is to, whatever this future value that we are going to pay at 10% for this loan has to equally categorize into 3 year-end payments. Okay. What does this going to give me? If I discount this value by 10%, I have to get a number of p divided by 1.1. If I discount this number, this is again p divided by 1.1 to the power 2. Why? This is after 2 years. Last year, I have to get a 12 of p divided by 1.1 to the power 3. Now, look at the hint again. Question says loan amount should be equal to the present value of the future annual equal installments. Now, in that case, what eventually we are doing is that we have to discount these cash flows to today's term, take the summation, and that will be equal to 50 million. That's the hint says. Loan amount, again I reiterated 50 million, so it will be equal to the discounted values of individual cash flows. Okay, got it? We'll do a equation write up and see. So this 50 is equal to, I have 3 p's, p divided by 1.1, p divided by 1.1 to the power 2. Now this is the equation that we can come up. So you have different ways to resolve this. First thing is that you can take your calculator, do simple equation like you can take p out as a common factor. We have 1 plus 1, 1 plus 1 to the power 2, 1 plus 1 to the power 3, and now we can easily resolve p from this equation. Another method would be to think like this. In the previous question, we have given the discount rates. So these numbers are given. So easily, instead of taking the calculator, you can add up the 0.9091 plus those discount factors given and then get P. That method is also not bad. One thing which you may forget is that this is a series of cash flows, equal amounts, and in theory we call this as an annuity payment. So for annuity also, so provided let's say you have a, instead of 3 years, now this is a straightforward, you have only 3 years. Let's say you want to distribute for 20 years, if the questions ask so, can you do this? Okay, you can do it theoretically, but might take a little time. So in that case, you can use the annuity equation which we learned last week, that is the this particular part for the number of years that you are going to use the discount rate. So that is nothing but I'm going to just take this piece off for a moment. If I add these values up, it is going to be exactly be given by this equation. If I just apply these values to this equation, this is pretty easy. We have 1 minus discount rate is 10% in this sum, so 1.1 negative 3 by n is a 3-year project, n is going to be 3, but the equation we are going to apply as a negative. Remember, for the discounting it was a negative. If you take a future value, this equation nicely goes to the other side like this. Same equation, which is this part, will go from here to here. One is a negative, one is a positive. This is if you have been asked to calculate the future value, not the present value. Okay. So if you use this equation, this is 1 minus 1.1 negative 3 divided by 0.1. This will become really handy if the n is something like 20, where you can't really add up these numbers. You may do mathematical errors, computational working errors. So this equation is straightforwardly by using a calculator you can get the answer. Right. Either way, you can resolve P, and if I equate to the very basic form of 50 equals to payment 1 to the power 2, you have to get a payment amount of approximately 20,106,160. Somewhere around 20.1 million is going to be your equal installments at each this point. 20.1 here, 20.1 here, 20.1 here. That's your payment. Right. We'll look at the part 3. The hospital decides to save money for a period of 3 years. Now they're not going to go for the loan. They're going to save money for a period of 3 years in order to form a fund of 75 million at the end of 3 years for this laboratory to upgrade and some more repairs. Okay. Instead of going for a loan and doing this repair now, they need more money and they're going to go for a saving instead of taking a loan like this. Okay, fair enough. This fund will form by crediting equal amounts. S. Let me write those values. So there's no more 50 million here. There's no more 20.1 million loans. Rather, they will have S's like this. Question says, this fund will be formed by crediting equal amount S and earn interest at 10%. First installment of this fund will be paid immediately. Right. There's another S here. Immediately. First installment. Year 0. And next 3 installments will be paid at the end of year 1, year 2, and year 3. However, the last installment, this one, will not earn any interest. That's fine. This S will not get any interest. It will lay as it is. So if I just try to do a sum up of what I learned so far, this S will be S. This S will earn an interest of 1 year, S into 1.1. Similarly, this will be S into 1.1 to the power 2. And this year 0, S will be S into 1.1 to the power 3. These are going to be my 4 savings that will earn an interest of 10%. Calculate the equal amount S that needs to be credited to this fund annually to make it 75 million by the end of year 3. Very straightforward. I have to have a value close to 75 million by adding up these numbers. So mathematically, if I write it, I should get something like this. 75 million should be equals to S. I'll take one at a time. S into 1.1, S into 1.1 to the power 2, and S into 1.1 to the power 3. So this should be equal to 75 million. Okay. So I can take S out. This should be 1 plus 1.1 plus 1.1 to the power 2 plus 1.1 to the power 3. You can mathematically resolve this and get a value for S. S should be equal to 75 million divided by these additions. So this is going to give you a S of 16,160,310. You use your calculators and resolve it. Okay. For this addition also, you could recall from our previous discussion, we can use this equation of 1 plus r to the power n minus 1 divided by 0.1. This multiplied by S is going to be equal to 75 million. This equation is also applicable in this instance. So instead of, so here it should be 1.1, here it should be 3. You'll get value for this part. 75 divided by that part will be the value for S. So the summary of this story, if you save 16.16 million every year, 16.16, 16.16, 16.16, and the last one is also 16.16. We will get a value of 75 million to form our fund. Okay. Right. Last part. Calculate the expected balance available at the fund after carrying out the planned laboratory upgrade at the end of year 3. Is it simple? 75 million minus 50 million, 25 million? No, that's not the case. Look at the wording carefully. Calculate the expected balance available at the fund after carrying out the planned laboratory upgrade, last line, last part, at the end of year 3. So that means this fund will be used to do the laboratory upgrade after 3 years. If you look at part 1, that is what we calculated. Calculate the estimated cost of this required laboratory upgrade in 3 years' time. So we will have to use 66.55 million from this 75 million, and the residual will be the remainder of this project. So this should be 8.45 million is going to be the answer. This is what is going to be left if you do this laboratory upgrade after 3 years. Easily, you could get carried away with this question. You see a 50 million project upgrade, you see 75 million after 3 years. If you take the difference, be careful. That's not like with like comparison. This 75 million is at year 3. This 50 million is at year 0. That was our beginning discussion. At 50 million, when we do the compounding and then we take it here, the year 3, it is equal to 66.55 million. That's it, a complete 20-mark question. Look at how versatile the examination questions can be. The theory that we learn is somewhat straightforward. But when you look at the application, you could be carried away by the wording, you could get distracted, and you could get different meanings. So don't worry, just be very open-minded and read the question again and again and see whether you're making any mistakes. We'll move to the next paper, 2019 March. Question subpart 8 of the first question. Two banks, Bank A and Bank B, quote the following nominal interest rates for their savings. Bank A pays interest at 8.4%, compounded monthly, and Bank B pays 9.8% compounded semi-annually. Which bank pays its savers the most interest? Justify your answer. If you look at these past examination questions, there is this justification being asked many times. When you have been given two different interest rates with two different time horizons, of course, we can't do a like with like comparison. Why? These two numbers that you see here, 9.8% and 8.4%, are for two different periods. Sometimes it could be monthly, sometimes it could be semi-annually, sometimes it could be quarterly, different types of cash flow. So in each of these questions, the justification that you are going to give is by taking the annual effective rate. Okay. So the annual effective rate is a good comparison for you to do a justification to compare these different interest payment periodicities into one annual payment equivalent, AER, annual equivalent rate or annual effective rate. Okay. We will straightforwardly use the equation that we learned last week. That is the equation on the annual effective rate. Annual effective rate is going to be equal to AER 1 plus nominal rate divided by number of payments to the same power minus 1. 1 plus your nominal interest rate divided by the number of periodicities and the same power minus 1. This form we will apply to two banks and see what they are paying. Okay. First bank, Bank A, is going to pay me 8.4% compounded monthly. In that case, I can take 8.4% here, divide by 12 to the power 12 minus 1 and get the AER for Bank A. What about Bank B? Bank B is going to pay me 9.8% compounded semi-annually. In that case, we have two cash flows for a period of 1 year. Two cash flows for a single period. If I write the perfect equation, this has to be both sides. One annual payment, I am going to equal to 12 semi-annual payments here. So this is going to be 1 plus AER. This is going to be 1 plus, let's say the rate is T to the power 12. In that case, why I have taken minus 1 directly here is that I am going to straightforwardly take AER. In that case, AER is this minus 1. This is the form if you have to do a perfect comparison. But straightforwardly, to do quick computations at the exam, we will keep the AER in mind and we can apply it. So for the B also, I have 1 plus 9.8% divided by 2 minus 1 is going to give me an answer. So the answers that I should be getting for these are, one should be 8.73 and the other one is going to be 10.04. Now we have a common ground. If I write it perfectly, this is PA, this is PA per annum. Now I have two numbers in a same equal timeline. I can do a comparison now. Bank B seems to be paying more interest. The justification should be the argument for the annual effective rate. We have to make it compare in an equal ground to compare these numbers. Otherwise, we really can't come to a conclusion. Okay. Same question paper. We have another question, interesting one. Question number 6. 6 is in the recent past paper, 6 is the paper. 6 is the question where you have 5-mark questions on distinct areas. Subpart number 2. Take a look at that question quickly. An investor is considering two options to undertake an investment. All two options have same initial investment, but different revenue patterns are given. Okay, that's the important thing. Same initial investment. So that means from investment A to investment B, if at all the question is asking us to do a computation of the net present value, we don't have to take the initial cash out. Rather, because it's going to be a common pattern. It may be hypothetically 100,000, it may be 1 million, it could be anything. But as long as we are going to do a comparison, we don't have to care about this initial investment. Look at investment A. Investment A, investor receives 2 million rupee each for the next 5 years. Investment B, investor receives 1 million in the first year, increased by 500,000 each year until the final receipt of 3 million in the 5th year. You may use the discount factors given in the table below. So that means, in the same question, table below, at 10% discount factor, they have given us the discount factors as appropriate to answer the following questions. Look at the first question. Using a discount rate of 10%, calculate the present value of both investment. Second part is going to ask you which investment should investor select. These are very straightforward, easy questions for you to score marks in a quick pattern. Good thing, always don't forget to do a timeline, otherwise sometimes you may miss certain important details. But what's the first project is going to give us 5 years, 2, 3, and 5. 2 million each. I seems to be having an investment here, which I don't know. Could be anything. And the second project, same intervals if I plot the scale. There is another investment here. These are same. These are same for project A and project B. The name is investment A and investment B. This one first cash flow is 1 million and an addition of 500,000, 500,000 at each year until the last value of 3 million is being reached. So this is the pattern of the cash flows. Question is easily giving us the discount rates. So we have this discount rates of 9091, 0.8264, so on and so forth for these respective years. And the discount factors, then I can take the present value of these cash flows by easily multiplying these numbers and get here. If you want to do a shortcut, instead of doing this multiplication, we have the same cash flow. This is another annuity. So you can take the equation of 1 plus r to the power n minus 1 divided by r also. But since these are only just a couple of calculations, just multiply these numbers and you should get a present value series here. So the net present value for this project, if you do this multiplication and get here, it should be investment plus the value of 7.58 million. So this minus investment is going to be your net present value. The question is asking, using a discount rate of 10%, calculate the present value of both these investments. So it may not be the net present value since we don't know the investment, but the total present value. So the same if we do for this project, we have 1 million, 1.5 million, 2 million, likewise. We use the same discount rates and do the multiplication and take the addition of individual items which is coming here. You do this addition using your calculators, you should be getting a value close to 5.358 million here. Very straightforward argument. We have a project with an initial investment of same yielding a higher present value. So obviously project A is the better one, project B is the less better one compared to each other. Straightforward, 5 marks. For part B, which investment should investor select? Justify your answer. Again, write a bit of theory on the present value and make sure you mention the theoretical background of net present value decision making, the positive, the negative, and the higher the better, provided you have to select one project. In that argument, you are selecting project A. That should be the better representation. Okay. All right. We'll move to 2018 paper. I have MCQ. Part number 4. Consider the following statement on the net present value. Consider the following statement on the net present value. Which of the following is correct for the above statements? Right. First statement. NPV is the present value of expected future cash receipts. Now that's the trivial word. Receipts. Is it only going to be receipts? Last week discussion we said it could be a positive cash flow and a negative cash flow. So for you to take the net present value, we can't only consider the cash receipts or cash payment, but everything together. So the first statement is going to be considered as a wrong statement because of the word receipts. It should be, if the statement is being reworded as, let's say, future cash payments and receipts, okay, that seems to be a better statement. We can't take that statement. B. Determination of appropriate discount rate is difficult. Of course, that's one of the biggest hurdle of the net present value. You have a different number for a net present value, sorry, different discount rate for the project appraisal. Obviously, you're going to come with a different net present value. So sometimes you can window dress this project appraisal by changing your discount rate, changing your required rate. So this is a correct statement. C. An investment with a positive NPV is financially viable, of course. That's the decision rule. So C is also seems to be a correct statement. Last one. IRR, internal rate of return technique, is a superior technique to the NPV. Now that's also seems to be a misleading statement. Why? Last week's last part of the discussion, we learned that NPV and IRR are two independent and distinctive methodologies to do project appraisal in different ways. NPV is going to tell you whether at a particular rate where you are going to get a positive value by running this project or a negative value. IRR is nothing but the exact rate which your NPV is going to be zero, or NPV is going to not get any positive or negative value, rather a break-even kind of a value. So any rate of return higher than the IRR, you're going to get a negative NPV. Any rate of return which is lower than that IRR, you're going to get a positive. So it's sort of like determining a hurdle. So we can't really say IRR and NPV, one is superior to the other, inferiority. No, it's not the case. Both are two different techniques. So D is also seems to be an incorrect statement. In that sense, we can choose answer C, B, and C only. Okay. This is straightforward theory questions. Same question paper, we have part 8. Sorry, part 7. A bank offers depositors a nominal interest rate of 10% per annum for 3 months with interest payable at maturity. Calculate the annual effective rate of interest. It's a very straightforward calculation. Let's use, I don't think I have to use the board, but I'll just verbally tell you the computation. What's the rate? Nominal rate is 10% and 3 months per annum for every 3 months. So that means a year has a period of 12 months. 3 months here means this 10% will be compounded 4 times. So your annual effective rate should be 1 plus 10% divided by 4 times to the power 4 minus 1. 1 plus 10% divided by 4 to the entire thing to the power 4 minus 1. That's the AR equation, which is going to give you a annual effective rate for that 10% as 10.38% if you do the calculation correctly. Straightforward answer, 2 marks. Okay. 2018 September, question number 6, subpart 2. This is also a very straightforward question coming from the theory of depreciation. Passenger lift at an apartment complex need to be replaced in 3 years' time. After the installment, the lift starts to depreciate at an annual depreciation rate of 10%. The supplier has quoted the current price of this replacement as 15 million. The current, if you do it today, it will cost you 15 million. But if you do it after 3 years, obviously, it's going to be compounded by 1.1% to the power 3, isn't that so? This estimate is forecasted to rise by 10% per annum. Now that 15 million is going to be compounded by 10% on a compound basis. You may use the discount factors on the table below. First part, calculate the estimated cost of the required replacement lift in 3 years' time. Second part, assuming the depreciation of the lift happens as straight line method of depreciation, calculate the total amount of depreciation and the value of the lift in 3 years. Okay. This is where the theory of depreciation and the present value can be combined and nicely carve a fresh kind of a question. So confusingly or easily, the discount rate and the depreciation rate is the same. So obviously, we don't need these numbers because why? We're only considering the value after 3 years of this particular piece of equipment. The first part, we'll look into the first part first. Calculate the estimated cost of the replacement of the lift after 3 years. We do it now, we have to spend 15 million. Yeah. If we do it after 3 years, that means this is going to get compounded by 1.1 to the power 3 and will be inflated by a value close to 19.965 million. Straightforward. 1.1%. Sorry, 1.1 will be the factor to the power 3 after 3 years is going to give me an inflated value of 19.965. Now, when you calculate the depreciation, now this is the important part now. When you calculate the depreciation, now this is the value of the equipment, not 15 million. Okay. The question is asking, assuming the depreciation on the lift happens and straight line method, this value, this 19 value, will be depreciated by straight line 10%. What does this depreciation theory says? If it is a straight line, if number of years are given, we can calculate the value easily. Now here, this depreciation rate is given as 10%. So that means equally, there has to be 10 depreciations, which will take this 19.965 value to 0. Okay. So each year, we have to get a depreciation of 1.1965 million as depreciation. That's the only calculation where we need to be cautious here. 19.96 million worth of equipment, if we depreciate, we have to get an equal amount of 10 installments to make this value 0. There's no residual value being mentioned under the depreciation theme. So this has to go to 0. That means this has to be divided by 10. Why the rate is 10? So easy. What the question is asking, calculate the total amount of depreciation. 3 years. I forgot about the historical part. Don't get confused here. If this is the depreciation, by 3 years, we have to get a total of 3 as the depreciation. So this should give me a value of close to 5.9895 as the total depreciation. When you take the current value of the equipment minus 3 years of depreciation, we have to get the remainder after 3 years as 13.9755 million. Although the discount rates and everything are given, we don't really need it for the computation of this question. Very straightforward. Same question, subpart 3. I think we are close to 1 hour of timing. We'll try to catch up with this part and then touch upon few MCQs and then wind up the session on the MPV questions. Even the deeper you go, the maximum that you could get is you could get annuities, you could get present value of annuities, future values of annuities, straightforward discounts, straightforward depreciations like this, and nothing much. You may get different types of cash flows bringing into the discussion, but eventually either it will be a positive cash flow or a negative cash flow. We have discount factors, multiply any cash flow. Now let's say a creative way would be, talking about these numbers, a creative would be, let's say, on the cash flows of a project, you may given, let's say initial investment is 100. In year 1, you may get revenue of 50, 50, and let's say 70 here. Then there will be different types of questions. Let's say marketing expense of 5, in year one. Let's say in year three, there's another positive cash flow coming because of something else, 20. On the same year, let's say there's another 10 going out as expense. So in these instances, what you could do here is take the net cash flow before you go for discount. That's the only other types of complication which we did not discount, which we did not discuss, which can come here. Always take the net cash flow and then use your discount rates here of let's say 0.90, 0.81, likewise 71, likewise. And in other instances, there could be one more complications. Now in these discount factors like 10% and 9%, it's very easy. You can use the question. You can use the questions provided numbers. But let's say you have a discount factor of let's say 7.51%. In this case, what do you do? Your tables or anything will not give you a value for this. Easily, you can use your theory. 1 plus 7.51% to the power 1. 1 plus 7.51% to the power 2. Likewise, in those instances, you can calculate. Okay. So other than that, I think pretty much NPV sums are very much identical, other than the complications of bringing in different cash flows and bringing in odd discount rates, where you can still use these equations to compute the net present value and the comparisons. Okay. Quickly, let's look at part B of, part 3 of question number 6 of 2018 September paper. Questions, again, a similar pattern. Project A, Project B, initial cash outlay of 300,000, and then you have nicely laid cash flows of 100,000, 200,000, likewise. First part is going to ask you calculate the net present value for project A and B using the discount rate of 10%. You may use the discount rate. So straightforward, if I write an equation for this NPV of A, it should be equal to 300,000 negative plus 100,000 divided by 1.1 to the power 1 plus 200,000 divided by 1.1 to the power 2 plus 300,000. If you have been given the discount rate in this question, multiplied by that number or divided by 1 to the power 3. This is going to give me a value for NPV A. NPV B, similarly, you can do the similar computation. The only difference is these cash flows are going to be. Okay. When I do the computation, when I do the calculation, I got answers of, for the A, I got 181,580, and B, close number 197,360. So B is obviously going to be a better one. Don't forget about the last part of the question B. Describe the major disadvantage of the NPV method in project capital. One of the major disadvantage would be the use of the particular discount rate. So by using a different discount rate, you can get a different NPV number, which is will be difficult to compare. Your required rate will significantly differ from you to another company to another entity. So obviously, determining the discount rate could be a good example where you can quote them. Okay. Right. So quickly, if I just touch upon the rest of the questions, this is what we discussed. 2018 March, two banks, Bank A, Bank B, we have a similar discussion. Bank A pays 8% maturity for 1 month fixed deposit. Bank B pays 9.5% maturity for 6 months fixed deposits. Which bank pays the more interest? For you to do that, you can do the similar computation, similar argument of annual effective rate. For Bank A, we have to take 1 plus 8% divided by 12 to the power 12 to the AR. Bank B, 1 plus 9.5% divided by 2 to the power 2. You could get 2 AERs. You will get a higher AER for Bank B here. Bank A, I got 8.29%. Bank B, I got 9.73%. If we discuss 20 now these questions, I will leave it for the moment. We'll see a couple of MCQs to wind up the session. 2017 March, question number 5. NPV. Part A says NPV of expected future cash receipts. It's a similar mistake. It can't be the receipts, it has to be both. Part B says IRR and NPV are two techniques used to appraise investment projects. That's the argument. Those are two techniques. It's a correct statement. Part C says the graph of NPV against discount rate has a positive slope. If you look at our graphs in the theory, it is not the case. It is having a negative. The higher the discount rate, your NPV is going to get a negative. So it's a 1 divided by alpha kind of a relationship. C, we can't also take it. D, an investment with a positive NPV is financially viable. So that seems to be a fair answer. B and D, we can get answer C for this question. Look at we look at this and wind up our discussion on NPV. Two banks, A, B, quote the following nominal interest rate for savings. Bank A pays 6.6% compounded monthly. Now in that case, we know how to calculate the AER. Bank B pays 6.5% compounded semi-annually, divided by 2. The bank A1 divided by 12. If you do the computation for bank A, you should get an AER of 6.8%, while bank B 6.76%. In that case, we have to select bank A as the better interest paying bank. Part 9. 5,000 rupees invested for a 3-year period at an interest rate of 12% per annum, compounded semi-annually. Calculate the total value of the investment after 3 years. Calculate the total value of the investment when the interest is compounded annually. Same AER equation. We have to multiply 5,000 by the rate that we can calculate. The answer would be 1 plus 12% divided by 2 for the first one. 12% divided by 2. Now the period, it is not going to be n equal to 3, rather n equal to 6. Why? Semi-annual means 2 annual cash flows. Okay, so the first one, part A, should be 1 plus 12% divided by 2, the entire thing to the power 6, not 3, 6. You should get a value of close to 7,092. Part B, it's not the semi-annual case, it's a typical annual. And it could be 5,000 multiplied by 1 plus 12% to the power 3. Why? We only compound it 3 times. You should get a value close to 7,024. It's just a computation. You don't have to compare anything. Okay. That winds up our discussion on the questions of the NPV. There are a few more questions. Don't worry, we will try to catch it up with an upcoming discussion, and hopefully at the revision also we will take a couple of recent question papers as well as some unique questions which we can see from the past couple of years. Okay. Having that area been finished, we are touching upon the fresh theoretical area on the valuation of fixed income securities. Okay. Now for you to do this lesson, we are carrying in ample number of theories that we learned on our previous discussion on the present value of the future cash flows. So when you look at the term fixed income securities, you may see it is going to be an investment which is going to pay me some sort of a solid fixed return for a, let's say, number of periods. So in that case, if you could recall, we discussed present value of perpetuities, annuities, and different types of cash flows. So the word valuation is going to tell us nothing but we are going to value these payments and get a fair value for a particular security. That is the brief idea on the valuation of fixed income securities. Broadly, we are looking at treasury bond and treasury bill calculations, pricing, the intrinsic value calculations versus comparison with market value, and take decisions based on these calculated values and current prices. This is the content that we are going to cover during the day. So the first two sections, although it has nothing to do with the computations and majorly not being tested anywhere, I thought of giving you a brief understanding on the fixed income securities, rather blindly go and just write some equations and try to buy them. So first, 2, 3, we will learn what fixed income securities briefly, what sort of terminology are being used in the fixed income securities. Some of you may already been exposed to fixed income securities in your previous studies, but some, this may be the first time that you are learning fixed income security computation. So before we go to the numbers, we will learn what those are, some covenants, some terminology that is used, some conditions, some nature of the security. And then area 4 and 5, we will briefly touch upon few computations and see how this is going to be related to what we learned under the present value of the future cash flows kind of lessons. Okay. So a fixed income security is nothing but a financial instrument. So there are different terminology of fixed income securities, fixed income instruments, uh, bonds and bills, debentures, bonds and debentures. So most of these terminology will be cross-referred in different jargon. However, the moment you see the word fixed income, we have to take in mind that we are talking about a broader umbrella of financial instrument which an investor lends money to a corporate or an entity or the government that borrows this fund for a defined time period at a fixed interest rate. That's the broader definition of fixed income security. So you, as the investor, you buy the security. That means you're lending money to the person who is issuing this security. It could be a corporate, it could be the government. If the government comes in, there's another term. If the corporate comes in, there's a different term. So broadly, you lend money. You as the investor, you lend money. They as the borrowers, they take the money, and uh, in sensible terms, they have to use that money, generate some revenue, and pay your interest and keep a remainder to themselves so that they could be profitable. So like they borrow money from you and do an investment, get some money, pay your return, and close the deal after a couple of years. That's the nature of these instruments. Nothing uh, complex like a derivative instrument or a complex financial instrument. Such funds shall be utilized by the borrower to finance various projects or activities. So government usually borrows this and use it for the government spending on various utilities. It could be health sector, it could be education, it could be roads building, various capital expenditure for the line ministries, it could be anything. And then they have to pay the interest and the borrowed amount after the distinct year of the security. We call it the maturity. Lastly, FIS can provide a stable level of return to investors over a different investment horizon. What's the difference? Let's say you have a portfolio of equities, common equity. Then the difference is, unlike a fixed income security which pays you a common return, which pays you a fixed or a stable return, equity may pay you dividends or may not pay you dividends. If the company performs better, it may pay you supernormal dividends also. And if it is a bad period like the COVID period that we are having, they may not pay dividends or they will pay a lesser dividend. So it's not a fixed return. So for a lot of people like superannuation funds, investment funds, gilt edge funds, uh, let's say retirement benefit funds, investors who are looking a fixed return, investors who are risk averse are preferred to fixed income securities over any other security for that matter. So the idea of the fixed income securities are to provide a stable return. Now these cash flows are known. These cash flows are known and defined times, defined rates. So the broad idea of the fixed income securities is that investor lends money, get a fixed return over a defined time horizon. These are some of the terminology used in fixed income securities or fixed income instruments. The first one, par value, is the most important terminal. The par value is the face value of the security at the time of issuance, prepaid at the maturity. In a typical, now in the Sri Lankan context, if you look at a lot of instruments is carrying a par value of 100 rupee. Sometimes it could be 1000 rupees, sometimes it could be 10,000 rupees. It could be 1 rupee also, it could be 10 rupees. You usually, majority of the time, 90% of the times, we see the par value as 100. So that's why in some of the equations in some jargon, you may see 100 being used, indicating that par value is 100. Especially in the computers like treasury bills, some equations, if you blindly just see the equation, you may see 100. That indicates that the security is a fixed income security and we're talking about a par value of 100. So par is nothing but the face value of the piece of paper which the security is being written. So historically it was physical paper. Now most of the exchanges has turned to electronic way. So we don't see those papers anymore. We don't see this par value, but hypothetically we call it as the par value 100. Coupon percentage is the second important term. So this is nothing but the periodic interest payment. Instead of using the word interest in a typical investment like a fixed deposit, in fixed income terminology, we call it as the coupon percentage. So if you want the actual coupon payment amount, what we have to do is we have to multiply the par value. Let's say my par value is 100 and my coupon is 12%. That means my coupon payment for that whatever the period is going to be 12% multiplied by 100. That is going to be 12 rupees. But if my par value is 10,000, so that means 10,000 multiplied by 12%. That means my coupon payment is 1,200 per annum. Typically, these coupons are defined as a per annum terminology. In that case, 10,000 multiplied by 12% is going to give me a coupon payment of 1,200. Okay, that is how we determine the coupon amount. Yield, third term. This is the most important term rather in this whole terminology to me. Yield is nothing but the return that is generated to the investor by holding this security. It could be until maturity or it could be an interim period. Let's say if you enter into this security, if you go and jump into the buy side of the security at the exact date of issuance, and let's say the security is going to have a value of lifetime of 3 years, and if you hold until the end of the 3 years, the yield percentage is, we call it the yield to maturity. That means you will get the yield, the percentage, which is equal to the value that you will be generating by the interim cash flows, by the coupons, plus the last cash flow which you will be get at the maturity. It's like a typical fixed income. So it's typically like a fixed deposit where you invest some money. With that money plus some interest you will get at the end of the period. So yield, sometimes yield could be equal to the coupon provided you enter with the security with the exact par value. Let's say the value of the security is 100. You pay 100 on the same day. So in that case, we can see coupon and yield are coming hand in hand. But instead of 100, let's say you pay a different value at the beginning. Instead of 100, you pay 105. Or you pay a lesser number of 92. But at the end, at the maturity, you get the same 100. Okay. When you look at the timing, you will understand what I'm trying to elaborate here. So instead of we start with 100 and ending with 100. If you change your start, this yield is also going to get impacted by that. That is where you can clearly understand what the yield is. Because you start with a different number, you end with a 100 and entering cash flows. It's like a typical project cash flow. You have a first negative outlay, then you have some cash receipts by year 1, 2, and 3. Then you um, take a value by discounting at a certain number, then you get a net present value. You will see coupon and yield and the price of the security are entangled in a nice set of equations where you will understand what the yield a little further and how it is being calculated. If you look at the fixed income terminology, especially the treasury bond yield calculations, you will see almost all these numbers are being expressed by the value of yields. If you look at the market news at a evening news bulletin or a newspaper or a research publication by a money broker or a stockbroker, the moment you see the yield, that means they're talking about the return of the investors that are getting by holding a particular set of securities. It may be a 1 year treasury bill, maybe treasury bonds, maybe corporate debentures, maybe a generic, common terminology for 2 year investment, 3 year investment. If they call it the word yield, keep in mind that it's nothing but the return. Obviously, it is what we are going to compute by this lesson's essence of computing the valuation. That's the essence. Okay. Last couple of terminology, market value, settlement date, and maturity date are pretty much straightforward things. Market value is the price at which the securities are traded. It could be, now we start with the initial value. It could be anything. Then we know the last value has to be the par value. That's the 100 at the end of the security's lifetime. And then the market value is any value that could be in between traded. Let's say it could be 98, it could be 73, it could be 120, it could be any number. It's the market demand supply determinant equilibrium point. And the last two dates are important. Date of settlement is a term that is used to mention the exchange of ownership of this security from seller to the buyer. At the first instance, this could be the issue date. So the issuer, the seller is the corporate or the government, and buyer is you, the investor. So in that case, the settlement date could be the issue date. But if it is in between, let's say I own this security and after 17 days, I'm going to sell it to Nimal. So Nimal is going to get the security from me at a particular date. When Nimal gives me cash, I give the ownership to Nimal. On that day, that means that 17th day from today is going to be the settlement day for that particular transaction. On that day, my security belongs to Nimal and I am no longer having any entitlement for this security. So in questions and all, if you see the settlement date, keep in mind that that is the day where you have to take as a beginning for the next person, the buyer, to own this security. Last but not least, the maturity day is the last day of this security is being in the market. After that day, this security is no longer there. That's one difference, or rather a compare and contrast between the fixed income securities and equities. Equities typically tend to have a long lasting lifetime. So they they assume to be last forever until the closure or a merger or a acquisition of the company by another company, and the security is no longer being viable. So it should theoretically go until perpetuity, where you will not see an end. But unlike those securities, the fixed income securities has a maturity date. That means at that day, the security will be expired and that securities ID will be taken out from everybody's books and that security is no longer there. So these are some of the terminology that we are widely using in this fixed income jargon. Okay. Now this is an illustration where I want to show you what we discussed so far by putting up the jargon that we learned. If you look at these timelines, forget about the bottom timeline for a moment. Just focus on the top one. You see a nice line stemming from left to right. I have y0, y1, y2, y3, y4. Those are years. I have indicated years by the term y. So on top of each of these years, if you look at the English wording, now y0, that's the initial point. I call it as the initial investment. That negative 92.73 something should be my initial investment. Coupon 1, coupon 2, coupon 3, and coupon 4 on year 4 are the coupon payments of this particular security at 12%. If you look at those numbers of 12, 12, and 12 in Y1, Y2, Y3, that indicates an equal coupon payments of 12. And if you look at that coupon 4 plus maturity of the initial investment, where on numbers wise I have mentioned 12 plus 100. Now that 100 is the par value that you are getting at the end of the security's lifetime. Now after Y4, this security is no longer there. The Y4 last point is the maturity date. So in this first one, Y0 is the settlement date or the beginning, the initial investment or the issue date of the security. Now, if you look at a typical scenario of this security being issued at 100 instead of this weird number of 92.73, you will see negative 100 at year 0, 12, 12, 12, and 12 plus 100 at year 4. Now, in that case, if we calculate the yield of this particular security, okay, if we calculate the yield of this particular security, that will be exactly 12%. Why? We start with the investment of 100 and we see coupon payments of 12, 12, 12, and 12 plus 100 at year 4. Okay, so in that instance, when we, no worry, we will do the yield and price calculations in a little while, then you will understand what these differences are and how to compare these numbers. But for the moment, just try to grasp what I'm saying. If I have a initial value, this intrinsic value that is calculated, forget that part. If I have 100 here instead of this 92.7350, then this yield is going to be exactly 12%. But the moment it differs from that 100 point, you may see the yield or the value that is being calculated for that yield is going to be also differ from 12%. It may go up from 12% or it may go down from 12% also. However, until we calculate, just bear in mind that at a particular yield, if you value this security, you may get a different number from 100. It may be a value less than 100 or it may be a value higher than 100. Okay. So for the moment, just bear in mind that there is a value called yield, and based on the value for that yield, the security that is going to give me these 12, 12, 12, and 12 plus 100 will give me different starting values. Or for different starting values, I may get different yields. Both could be hand in hand. Both could be discussed hand in hand. Okay. Now look at the second diagram. Now, interestingly, I have grayed out this y0 and y1, and at a particular point I have put dd, mm, and y by y. What I have done here, I just want to indicate that at a particular date in between year 1 and year 2, this investment could be started. Let's say this year 0, I bought this security myself. I bought this security, let's say from Sampath Bank. Okay. Then on this particular date, DDMMYY, the security I bought from Sampath Bank, I am going to sell it to Nimal. So at this particular date, let's say hypothetically this is 1st of July 2021, after year 1. At this particular day, Nimal is going to get the ownership from me at a value of 98.1340. And if I sell this security to Nimal at this particular price, that means I can calculate a different yield for this investment at this particular date at this particular price of 98.134. It could be other way around also. For me to sell this security to Nimal at a yield of 11.22%, I have to calculate the value of 98.13. Oh, if I sell this to Nimal at 98.13, effectively I am selling this at a yield of 11.22. Either way, either by using the price or by using the yield, we could denote this particular transaction. What is this small value I have written here as accrued interest? Now that means this from year 1 to year 2, if I hold this security, at year 2, I am getting 12 rupees as the coupon 2. Now what I have done here, in between a particular day, I have been holding this security, let's say for 180 days out of 364 days. No, let's say precisely I have hold this security for 182 days out of 364 days. Now in that case, exactly half 0.5 or 50% of the timing I have hold this security and Nimal is not in the picture. Now Nimal is coming to the picture on the 50% of the time between year 1 and year 2. Now what Nimal will be getting? Forget about the yield, forget about these numbers. Year 2, after 6 months, Nimal is getting 12 rupees. And after 364 or 365, this year 3 coupon 3 triggers, he is getting another 12. Year 4, he is getting another 12 plus 100 and he's happy, and end of the security, it is being matured. But what will happen to me? Now I've been holding this security from year 0 to year 1. At year 1, I got a 12 rupee. I am happy. But for this 6 months period, theoretically, I have to get 6 rupees for the holding of the security, and I have to get the 6 rupee from Nimal in order to be this transaction a fair transaction. Now this term accrued interest is nothing but apportionment of a particular coupon payment for the timing in between the coupon periods, number of days or months or weeks, whichever we are using to calculate the coupon payment. In our example, myself and Nimal's, I said I hold this security for 182 days out of 364 days. So if we take the fraction of my holding duration, that is 0.5%. So theoretically, 6 rupees I should get from Nimal at this date, and Nimal will be getting 12 rupees after 6 months period. So effectively, he will be getting 6 rupees. So that is this term, last term that we need to learn under accrued interest. So if at all there's accrued interest computation, not rocket science, you have to multiply the coupon by the fraction of holding and apportion it to the first person, uh, his holding fraction, and the person who is buying the next fraction. Let's say I hold it for a period of 3 months and Nimal is going to hold it for a period of 9 months. So that means this is going to be 1, 2, 3. So that means 1 divided by 4. 25% of the time it's with me. That means I have to get 3 rupees. Nimal will get 9 rupees. Okay. That's about it. That's the brief introduction onto the terminology and a visual representation of how these different cash flows are being laid in a particular securities timeline. Okay. The term covenant stands for qualities or uh, let's say certain descriptions of anything. So the covenants of the fixed income securities, this is where I'm trying to explain you the different names or types that we can subclassify these fixed income securities and the different naming being used by convention. Okay. So first one, based on the issuer, fixed income securities or bonds can be broadly categorized as if the government issues it, we can call it as a government bond or a treasury bond. If a corporate issues it, we can call it as a corporate bond or a debenture. Okay. So depending on the timing or the maturity, FISs or fixed income securities can have two categories. So less than 1 year, we call it the government bonds will be called as treasury bills. Corporate ones will be called as commercial papers. So these are securities less than 1 year. If more than 1 year, typically the government ones, we can call it as the treasury bonds, and the corporate ones or the commercial ones could be called as the debentures. So these four terms, treasury bills, commercial papers, treasury bonds, debentures, are the classification based on the timing and the issuer's nature. Okay. So depending on the coupon types, fixed income securities can be classified as zero coupon. That means there is no coupon. There is a starting value and an ending value. So can theoretically you start with 100 and end with 100? No, it can't be the case. Obviously, your starting point has to be very much low in that case. Let's say you start with a 92 and end with 100. There's no in between cash flow. So that means if you do a project calculate, sorry, NPV kind of a calculation, present value calculation, you will see some return. If you start with 100 and end with 100, obviously you will understand your value will be depreciated. Why? Because there's a inflation or a compounding effect which is going to uh, deplete that 100 at your end of the timing from 100 to a lesser value. Okay. Zero coupons. So zero coupons are there where there is no in between cash flows and there's one starting value and there is one ending value. Typically, ending value is 100 and your starting value could be a different number. Okay, right. Variable coupon and fixed coupon. Now, fixed coupons are the ones that we discussed so far: 12%, 13%, 10% kind of fixed coupon. However, in certain instances, you may see variable coupon securities also. In our local market, rarely variable coupon securities are also available. So in that case, you may argue, how can we call those securities as fixed income? Why their return varies? Isn't that so? However, those variable coupons has a fixed component in typical terms, has a fixed component, let's say 5% plus a variable component. And those variable components are also calculated well in advance for a period. Let's say a good example would be your variable coupon. Now zero coupon we discussed, there's no coupon. So C is equal to zero, no C's. Fixed coupon, C, the coupon payments will be equal to K percent, 10%, 12%. So the variable coupon, your C coupon will be equal to, typically it carries as a fixed component, 5% plus LIBOR, 5% plus treasury bill rate, 5% plus inflation rate. Now those numbers, those variable components are calculated based on another distinct value, which is being published or which is being calculated by a an independent party at a very reliable method. So typically those variable coupons, they don't vary from day to day. Rather, for a let's say semi-annual coupon, variable coupon security, every once in 6 months, your next 6 month coupon will be calculated well in advance. So for the next 6 months, you know your cash flows, but the next upcoming 6 months, you don't really know. That will be again calculated after 6 months, again after 6 months. So you, based on your coupon type, if at all you have variable coupon, that means your fixed income security can marginally be moving away from the terminology of fixed income. Rather, it could be variable income. However, if you look at the jargon of the fixed income security, the variable coupon securities are also being considered as a fixed income security. Why? Because at a distinct time period, there will be a payment. The only difference in these securities will be the payment amount will be marginally different. For equity, can you say there's a defined coupon at a defined date? Sorry, a defined dividend at a defined date? No. Always the date will also differ, your payment will also differ. So uncertainty will uh, not help you to do a perfect calculation. But for these securities, you know the date. The variable coupon will only vary the amount at a advanced date for the next period. That's how it works. So based on the coupon, zero, variable, fixed are the three different types we can observe. So based on the redemption feature, that means at the maturity or the uh, nature of the ending from one owner to the next owner, fixed income securities can have following components or following features. Callable features, puttable features, and convertible features are some uh, terms that we can observe. Callables are nothing but issuer or the owner of the security can say after some time, I am going to call this security if I want to call. Let's say I issue this security at 100. After some times, after let's say 3 years, I embed a callable feature. At 3 year, I may call this security. At 5 year, I may call this security. So this callable feature is nothing but an embedded covenant which says this security could be redeemed, could be recalled. Putable feature, on the other hand, is that the feature that facility is being given to me, the issuer. After 3 years, if I want to sell it, obviously at the secondary market, I can sell it to anyone, but I can sell it back to the company if I want to. I can sell it back to the government if I want to, or whoever the issuer. So those callable and portable features can be also seen in fixed income securities. Convertible is also an interesting feature. That means this fixed income security could be converted to sometimes equity. That means that face value or the par value of 100 will be converted to the same company or a different company's equity. So at a distinct time period or at a trigger event. Now, the loss absorption securities of Basel III debentures that we can see some of the banks are issuing nowadays are a good example of a convertible feature. Those debentures are carrying a convertible feature. At a distressed situation, they could be converted to common stock of the bank. So those are also some of the features of the redemption based on the FIS. Now, this really doesn't help you at the examination. We'll move on with the computation part of the discussion. And for the purpose of this discussion, we will use a common term as bond to commonly denominate all these FISs that we discussed so far. The only difference from a bond will be the moment we are discussing a bill, a treasury bill or a normal bill. Sometimes we could call it as a commercial paper, which will have a less than 1 year maturity. Okay. Right. Now we are coming to the mathematical part of our discussion, the bond price. For a particular bond, we can have two values. One is the market value for a given day. Now today is 20th September 2020. For this day, there is a market value for a particular bond. That is nothing but the price reflected in the market based on the demand and supply. However, the intrinsic value, the second value, is the one that is the essence of this lesson. That is what we are going to learn how to calculate. That is the price that can be calculated by anyone by considering the present value of the future stream of coupon and the maturity payment discounted at a required rate of return to you, to the investor. That is what we are going to learn now. If I reiterate and if I use a board for a moment, this is what I'm going to highlight. For a particular bond at a given day, now based on all this terminology that we learned so far, for a particular bond's timeline for a given day, there is a market value. Let's say 97.1111. Here is a market value. But for the same day, on another hand, now I know there is a C13, C14, and let's say C15 plus maturity of 100. I know now there may be C12 here. Now I know for this particular bond, now I'm using the term bond, common purpose. For this particular bond, these cash flows can be discounted at a particular rate R, and I can calculate a value. Isn't that so? So that value is the intrinsic value of the bond calculated at this R rate. Okay. Now this rate is the yield that we discussed previously. I may match this market value of 97.1111 at a particular rate. Now that rate is going to be R if I calculate it. Mathematically, if I write it, if these are equal, that means mathematically I can say 97.1111 should be equal to this C13 divided by 1 plus R% to the power. Now this, we have to be very careful. It's not like a typical cash flow of 1 year anymore. This is number of days. Now we have to be very careful. This is number of days. This is number of days. I will write for the moment for you to understand. There is T1 time here, T2 time here, and T3 time from here to this last one. Okay. So at the rate of T1, C14 discounted 1 plus R to the power T2, this timing, exact timing, plus C15 plus maturity, 1 plus R% to the power T3. Now, if I am to resolve these two parts and equate 97.1111 to this particular R rate, I know this C has to be your coupon, 12%, something like that. So for this R, if I get a number which will approximate this part to 97.11%, that R is the yield. Or, on the other hand, this is the yield at this particular price. Don't worry, for your discussion purposes and for the examination purposes, I think we may not see such computations, because for you to do that computation, you may have to use some advanced mathematics, sometimes series analysis. But majority of our discussion and the questions that we see in this paper are coming from a straightforward computation or a comparison of this market value to the intrinsic value, and see whether you can see any advantage of buying this bond or not at your required rate. Okay, moving on. That intrinsic value, that value that I discussed a moment ago, can be calculated by this equation. If you look at our set of cash flows, what do we see here? We see a common coupon, C1, C2, C3, and C4. Those coupons, I am going to take it to one side. This maturity, or this 100, I am going to take it another side. I call it as a principal value or the maturity value. typically this is going to be 100. So in this case, at any point, I can calculate the price of a particular bond by dividing 100 or your maturity value by 1 plus R. Now this R is going to be determined by us, the required rate, by the period. Let's say 5 years, and for the discussion purpose, let's say there are no odd number of days in between like our example, but nicely laid yearly periods. In that case, this R is your required rate and this N is going to be your number of years. So in this case, this N could be 5 or 6 or 10 or 30 depending on the number of years the bond is last in the market. So this is one part, principal value, plus those coupon amounts divide by 1 plus R to the power T. Now those T's are the distinct year 1, year 2, year 3, year 4 kind of cash flows. Okay. By redefine, R is the required rate, N is the number of years or number of periods the coupon payments during the lifetime of the bonds. It could be yearly or it could be semi-annually, it could be quarterly, depending on those numbers, the N is going to differ. T is the respective time interval. So T could be, let's say, 3, 4, and 5, and 30, depending on the number of years. There's another elaboration coming up, so you will understand what these different T's are going to tell you. But for the moment, I just want to deviate marginally from this price of a bond to price of a bill. Now, previously we discussed bills are nothing but securities which we start with a discount, then it is going to end at a maturity value. So the lifeline of a bill in compared to a bond is nothing but C1, C2, C3, C4 plus maturity kind of a investment. Bill, this is your investment. Bill is you have an investment and then you have maturity. In between, no cash flows. So here we said we could start 100, we could have 12, 12, 12, and 12 plus 100. This is a viable scenario. Your yield will be 12%. But here, obviously, for you to make a return, obviously this investment has to be a lesser number. Let's say you invest at 92 and then mature at 100. In this case, there is a R% return for this particular time. But bear in mind, you can't start with 100 and end with 100 because obviously this whatever this rate is going to be negative in that case. So what I want to highlight here is that if we move away from this bond equation for a moment and look at what happens if we are going to consider a bill, what you can see is this coupon amount or this C is going to disappear. Why? We don't have any in-between payments. So then obviously it is going to be nothing but the principal value divided by 1 plus R to the power N. Isn't that so? So principal value is going to be 100. That's why I have used 100 here. Or provided your question says 1000 or 10,000, obviously forget 100, use that value. 1 plus R to the power N. But typically in bills, if I now this is valid for a period of, let's say, 3 years. If your bill has a value of 3 years, as the question says, okay, that's fine. Then 1 plus R to the power 3, and that R is going to be determined by you, and based on that R you will have a price. That's fine. But on a common sense, on a practical sense, the bill is a period of less than 1 year. So this N is going to be obviously less than 1 year. In that case, you can calculate the price of a particular bill by taking, instead of R, this R will be divided by number of periods on that case. So you can multiply R by number of days to maturity by number of days for an year. Let's say a good example will be, uh, let's say your bill will have a number of days to maturity of 182, and your number of days for an year is 364. So that means your bill price will be whatever the rate, let's say 9%, 100 divided by 1 plus 9% multiplied by 182 divided by 364 for you to get the bill pricing. No worry, these equations we will apply next week when we do a couple of calculations. And this is not the only way to calculate a bill price. There are different easy ways also to calculate other questions we will see. For the moment, just I want to highlight the fact that if we are considering a bill without interim coupon payments, we only have the principal value divided by 1 plus R. And if the if 1 plus R to the power n, if the n is less than 1 year, typically for a bill, the R or the rate per annum will be multiplied by the fraction for you to get the price. So this is nothing but this. What is this? This is the present value of a future stream of cash flows. This is exactly what we learned in the last lesson. What does this tell you? This is a 0 year, year 1, 2 up until year 10. And this coupon payment is calculated as 60 rupees coupon amount. The percentage I have taken as, sorry, in this, for this example, I have taken a par value of 1000 and 6% coupon as an example. Okay, so 6% by 1000 is 60 rupees. So that's why you see 60 rupee at year end of every year. Year 1 60 rupee, year 2 60 rupee, up until year 9, and year 10 60 plus 1000. That's why you see 1060 here. What I have done here, I have discounted them by this REQ rate, the required rate of 6.75%. For instance, I have elaborated here the year 8 example. Let's see that number. That means from today, after 8 years, I am getting 60 rupees. If I am to discount that, what I have done is I have divided by 60 divided by 1 plus 6.75%. This is going to be 1.0675 to the power 8. And effectively, this 60 rupee will be valuing 35.58018 as at today's terms. This particular value. Okay. So effectively, what I have done is I have taken all these future cash flows and I have discounted to today's term using my required rate of 6.75%. So that means for this bond of 1000 par value should worth, or this intrinsic value for me should be 946 rupees and 709 cents if I have to buy this with a return of 6.75. Okay. Effectively, what I have done is this equation decomposite into different coupon payments. This payment of principal payment of 1000 could be taken separately. So if I am to do this 1000 separately, what I do is 1000 divided by 1 plus 6.75% to the power 10. This is that particular portion. And all these 60s, 60 from year 1 to 60 up until year 10 is coming here. This is coupon multiplied by, what is this equation? This is nothing but the discount equation for an annuity. Isn't that so? Coupon payment is constant. It is valued at 60. So this 60 multiplied by this annuity equation will nicely give me the equation equivalent value. If you calculate this, you will have to get 1 minus 1 plus R R is 6.75% to the power negative 10 divided by 6.75. Now this multiplied by coupon 60 plus 1000 divided by 1 plus 6.75 to the power 10 is going to exactly equal to 946.709. This is nothing but the bond pricing. This R is your required rate, or the question will define you what the R is. Effectively, yield is this R. Why? For this particular set of cash flows, if you discount it by this particular rate, you will get a price at you are willing to trade this security. So this is the essence of bond pricing, what we want to learn. Intrinsic value, required rate, discount to calculate the value. Last bit of theoretical area that I want to touch upon is whether we want to see this calculated price, whether it is traded at exactly par value or a different value. That's where we start our discussion. So depending on the coupon of the bond versus the required rate, or the R, or the currently trading yield, or simply the yield percent of a bond, bonds may be traded at following instances. The first instance would be the par. If coupon percent is equal to yield percent, that means you can do a calculation and see, let's say in our previous example of 12%, 3 years, if your R is 12%, if you discount these cash flows at 12%, you will get exactly 100. If coupon percentage is equal to yield percentage means your R, your required rate, investors are receiving a return which is exactly equal to the required return from the bond. Hence, they are paying the par of 100. That means your starting value is 100. Now, other instances are these premium and discount instances. If the premium instance is prevailing, that means your coupon, that 12% coupon, is greater than your yield. That means you want only 8% return. Your yield is 8%, your R is 8%, but your coupon is 12%. In that instance, you are getting more money than 100. Why? Your coupons are 12, 12, 12, but you only need 8, 8, 8. That means if you do the discounting at 8%, you will come up with a price greater than 100. So the moment you see a price more than 100, you have to identify that it's a premium bond where it's a coupon greater than yield. And the discount bond is nothing but the exact opposite of this, where your bond is paying you 12% and you need 16%. So you see 12, 12, 12 and 12, but you need 16, 16. So effectively, if you are to equate this situation, if we are to equate this disequilibrium situation, you have to pay a price less than 100. Like in our bill example, you have to pay 92 or 91. There again, you are earning a small margin. If you pay 92 for a value of 100, you are earning a 8 rupee margin at instance 0. That means it's a discount bond. The price that you have to pay, or the market price that is prevail, will be less than 100. So these are the 3 instances which you want to see a bond being traded. It could be a par bond, it could be a premium bond, it could be a discount bond. So whether, now we have to forget the starting point, you have to forget the year 0. At any given point, if you just observe the price, and if you look at the coupon and the yield, if you just focus on the coupon and the yield, you can see whether that bond is a par bond, premium bond, or a discount bond. There are some questions. Sometimes you have to identify the relationship clearly. So this is an important remark. Lastly, let's see a couple of examples where you can calculate a bond price, and we will stop the lesson for the day. Okay. First example. I mean, all these examples are similar cash flows, just that I want to give you a glimpse of changing the yield and see what happens to the price. Will, in the interest of time, let me just elaborate one, and I want you to try the other two questions at home and see what calculations you can say. Your value is 1000 with a coupon of 9%. So that means 90, 90, 90, 90, and maturity is 5 years. So this is a 0, 1, 2, 3, and 5. That's another 90 plus 1000. Okay. Right. So this is the value. We don't know this. This is your starting point. This could be 1000, provided your yield is exactly 9%. Required rate. The first question says your required rate is, this is coupon. Required rate OR is 10%. In this instance, what you have to do is nothing but go back to your intrinsic value calculation. So the value or the price of this particular bond at R equals 10% is going to be nothing but your principal value 1000 divided by 1 plus R to the power T. So this is going to be 1 plus your required rate is 10% to the power of 5. Is that the case? Look at the question carefully again. If interest is paid semi-annually, now this is not 90. This has to be, this 90 will be paid 2 installments of 45 and 45 at every 6 months. Similarly, every 6 months. This is where you can get wrong. So theoretically, instead of 5 time periods, I have 10 time periods. Isn't that so? So 1000 is your par value. That's fine. Divided by 1 plus R. Is R 10% anymore? It's not 10%. It is 10% divided by 2 by your required return for a period of 1 year is 10%. That's fine as long as your interest payments are also 1 year. But it's a semi-annual cash. So this has to be 10% divided by 2 to the power n is 10. Students, interestingly, this entire set of questions on bond pricing, all what you have to do is you have to determine two things. What is R? What is T or N? This is only what you have to determine. If you don't get it right, obviously your price will be wrong. Okay. If I continue this, your price or the value, the intrinsic value will be, first I'm going to take the principal component 1000 divided by 1 plus 10% divided by 2 to the power 10 after 10 periods, plus my coupon is going to be 45. 45 either I can do a complete addition or independent addition, or use the equation of 1 plus 1 to the power negative n divided by n, this equation. So this is the easier method where you can calculate the bond price easily. So 45 is here, 1 minus 1 plus R. Now this R is 9% divided by 2. This negative n is negative 10. N is again going to be, sorry, this is not n, this is R. 9% divided by, this is the price of the bond provided. Yeah, sorry, this is, I have also messed up, sorry. price at the rate of 10%. So this is nothing but your R's 10 and 10. Sorry about that. Required rate is 10. Coupons are calculated. Coupon is 45. I can use the equation of compounding addition to get the compounded value of these 10 cash flows, 45 each, compounded semi-annually. Again, I reiterate, required rate R. If the question says annually, 1, 2, 3, 4, and 5, you can apply 10% and 5 here. But since the cash flows are semi-annually compounded and 10 cash flows are there, I have to take 10% divided by 2, and number of periods are also 10. Likewise, get a value here. We'll start with the computation of this at the beginning of next week, and we will discuss some couple of questions on treasury bond calculations and the papers, and we will wind up the session with the portfolio theory by next week with the end of the discussion on the mathematics series. Okay, reiterate. Try these couple of questions which I've given in the last slide. Coupon 9%, so this 45 will remain constant. Required rate will change from 10% to 12% to 8% in each of these instances, and try to see whether the value of the bond of 1000, when the required rate is changing from 9, from this 9% versus 10% coupon versus 12% versus 8%. Try to see what sort of a relationship that you can see in the pricing. At certain instances, if you calculate this entire business at a rate of 9%, you should get a value of 1000. So try that as well. Coupon of 9% and required rate at 9%. So for this, you should get a value close to 1000, exactly 1000, right? So compare this with the values of what you can see here, and then you will understand the relationship between the par bond, discount bond, and a premium bond, depending on your required rate. Okay. So thanks for the extra couple of minutes. Quickly reiterate, we discussed an important session on treasury bond pricing. Forget about the terminology, forget about the covenants. This is just to give you a brief instance into what these securities are. All what you have to focus is on the pricing. You have one principal value, which will be discounted at a rate, and a series of coupon amounts. So this is nothing but an annuity. The moment you see an annuity, you can easily apply this equation of 1 minus 1 plus r to the power negative n for you to calculate the value for an annuity. That's about it. Okay. Thank you for your time, and we will meet up with the last lecture for this lecture series next week with the discussion on the pricing of the the portfolio theory and some questions on the treasury bond pricing. Okay. Thank you.